Keppel is carrying a net debt to EBITDA ratio of 5.1 times. Their latest earnings update swapped hard numbers for vague adjectives. That is the forensic signal I want to walk you through today. Welcome back. Earnings and dividend season is picking up across the SGX. Thursday is shaping up to be a reporting day worth paying extremely close attention to. A handful of significant names have crossed my monitoring threshold this week. Today, my focus is firmly fixed on the forensic numbers for Keppel, CapitaLand China Trust, City Developments, and Oiltek. Some of these business updates raise serious questions we need to work through carefully. Others are actually cleaner than the initial market headlines suggest. Either way, this is exactly the kind of reporting window where the real story tends to sit one or two layers below what management puts in their public announcement. Looking at the broader macro picture, the STI is currently testing the 5,000 resistance zone on the back of Trump and Iran ceasefire news. The index price sits near 4,954. This creates a potentially dangerous divergence between the headline index price and the underlying health of individual counters. Do not let the headline number do your thinking for you. Meanwhile, the 6-month T-bill cutoff yield sits at 1.47%, and the 3-month compounded SORA is hovering around 1.06%. I will be updating the macro dashboard once the latest auction results are fully confirmed. But the current environment demands that we audit these yields with an absolute lack of sentiment. The monetary environment is shifting. MAS recently tightened policy by slightly increasing the slope of the Singapore dollar nominal effective exchange rate band. This move is designed to counter imported energy shocks, and the core inflation forecast has been revised upward to between 1.5% and 2.5% for the year 2026. For dividend investors, this matters immensely. A higher for longer Singapore interest rate environment fundamentally compresses the risk premium on anything yielding below my minimum threshold of 4.7%. If your portfolio is carrying yield vehicles that cannot clear this new benchmark, you are taking on equity risk without the appropriate compensation. This brings us to Keppel. This is a prime example of where reporting transparency dies and the dividend math gets incredibly murky. Keppel reported what they called a slightly lower year-on-year net profit for the first quarter of 2026. They pointed to lower real estate contributions and fair value losses from non-core assets. Absolutely no specific dollar figures were provided in their SGX business update. We already know their full year 2025 net profit was 16% lower than the previous year. Crucially, their net debt to EBITDA stands at a concerning 5.1 times inclusive of the non-core portfolio. That sits firmly in my caution zone, suggesting earnings erosion rather than a clean recovery. Sembcorp Industries maintains a significantly cleaner reported balance sheet. It easily passes the forensic flaw that Keppel's current reporting fog is completely obscuring. If we run a forward stress test on Keppel, a 10% further impairment on their non-core portfolio would likely push their gearing toward a critical watchlist trigger, particularly if higher for longer interest rates continue to suppress asset exit valuations. Think about a 55-year-old PMAT living in Tampines, approaching retirement and using their CPF ordinary account to invest in blue chips. The complete lack of profit clarity here means a potential 15% cut to the next interim dividend. That could delay their retirement SRS transition by 12 full months. When we run the forensic yield math on Keppel, the picture remains highly unconvincing. Based on the full year 2025 ordinary dividend of 34 cents, the yield at 11 Singapore dollars and 59 cents is exactly 2.93%. Even if you include the special dividend for a total of 47 cents, the total yield is 4.05%. Neither figure clears my absolute hurdle of 4.7%. The risk premium against the 6-month T-bill is only 158 basis points on the total dividend, and a dismal 146 basis points on the ordinary dividend. I strictly use the ordinary yield because special dividends are non-recurring and simply cannot anchor your retirement drawdown. At 5.1 times net debt to EBITDA, Keppel is carrying far more leverage than any sanctuary stock ever should. And here is what that actually means. Management's specific decision to describe a profit decline using vague adjectives instead of actual numbers is not just a communication style. It is a massive flashing signal. When the quarterly update stops using concrete figures and starts using words like slightly, the retail investor is always the last person to know the full story. The non-core drag on their balance sheet is not merely a footnote, it is the entire story. Until those assets are fully expunged without further fair value hits, the institutional optimism surrounding this stock is priced entirely on pure hope, not forensics. Now let us look at CapitaLand China Trust. The highly anticipated China recovery narrative has essentially hit the brick wall of reality. First quarter net property income actually fell 3.5% year-on-year to 282.4 million yuan. More alarmingly, the full year 2025 DPU is confirmed at 4.82 cents. That represents a brutal 45% decline from the 8.73 cents paid out in 2021. Their gearing stands at 40.7%, which is well above my 35% ceiling. Furthermore, their interest coverage ratio is sitting at 2.8 times. That is drastically below my 4.0 times minimum threshold. While the yield sits at 6.98% at a price of 69 cents, clearing the 4.7% hurdle on paper, it completely fails my structural test. We are talking about yield being paid on a leveraged, currency-exposed base with a rapidly deteriorating income floor. For peer context, Sasur REIT offers a much higher organic yield with a stronger interest coverage ratio. If we stress test CapitaLand China Trust, a 10% depreciation of the RMB against the Singapore dollar would slash distributable income by an estimated 6 to 8%. For a 60-year-old retiree in Punggol managing an SRS drawdown, a further 5% DPU slide represents a 1,200 Singapore dollar annual shortfall for groceries. An interest coverage ratio of 2.8 times is not a safety cushion. It is a severe warning light flashing red on the dashboard. CapitaLand China Trustees' yield looks highly attractive until you run the full forensic stack. You have gearing above the ceiling, an ICR below the floor, a DPU that is down 45% over 4 years, and the RMB carrying heavy structural depreciation pressure. This distribution is absolutely not being earned cleanly. It is being sustained by pure leverage on assets whose actual income is shrinking. One single bad quarter or one more downward RMB move, and the distribution gets carved up. The 6.98% yield is exactly the number management wants you to focus on. The 40.7% gearing is the number that actually matters. Let us turn to something cleaner. City developments. The recent update highlighted that 3 independent directors stepped down from the board of Millennium and Copthorne Hotels to focus their attention entirely on the main CDL board. If you are a 45-year-old HDB owner in Jurong supplementing your salary income with reliable dividends, this board reshuffle is essentially a complete non-event for your dividend check. It is simply a necessary step for management focus and streamlining. The real forensic audit for this company remains fixed on the hospitality sector's overall recovery trajectory and the heavy asset base the group carries. Because the fundamentals remain relatively steady for now, my forensic stance on city developments remains strategically neutral. Looking at the smaller cap space, Oiltek International is currently reviewing its capital structure. This includes a potential stock split and a secondary listing on Bursa Malaysia. If you are a 50-year-old investor in Ang Mo Kio managing a broader SRS portfolio, a stock split might generate a very nice short-term liquidity pop for your holdings. However, from a pure numbers perspective, the forensic floor remains completely tied to the actual execution of their Agritech order book. A capital structure review looks great on paper, but it fundamentally does not change the core margin profile of the business itself. Because the underlying operational metrics have not meaningfully shifted, my current forensic stance on Oiltek remains as a watchlist trigger. There is a massive disconnect right now between analyst chatter and forensic reality. Several institutional houses are currently remaining neutral on Keppel, specifically citing the company's transition to a global asset manager as a great long-term play. But applying my forensic filter tells a very different story. That long-term play simply cannot be properly audited while the net debt to EBITDA ratio sits dangerously at 5.1 times. The debt load is a concrete fact. The transition is a future narrative. Until the non-core assets are fully and cleanly expunged from the books without taking any further fair value hits, all of this institutional optimism is completely ignoring the massive forensic drag weighing down the immediate balance sheet. Let us summarize exactly where these specific counters stand on the forensic watchlist and their yield spreads. Keppel is currently priced at 11 Singapore dollars and 59 cents, offering a total yield of 4.05%, but only a 2.93% ordinary yield. Against the T-bill, that gives us a completely insufficient risk premium of 146 basis points on the ordinary basis, keeping it firmly as a watchlist trigger. Meanwhile, CapitaLand China Trust sits at 69 cents with a massive 6.98% yield. While it boasts a huge 551 basis point premium, the balance sheet absolutely fails the test, confirming its status as a highly dangerous yield trap. I need to reiterate exactly why I maintain such strict thresholds, regardless of what the broader market is doing. My personal forensic floor holds absolutely steady at 3.2%. The current 6-month T-bill at 1.47% is well below that floor. That is simply a reflection of an artificially compressed near-term rate environment. I do not lower my standards just because the risk-free rate temporarily drops. I strictly audit these companies for the coming storm, not just for the sunny day we might be enjoying right now. Therefore, the absolute minimum yield hurdle remains at 4.7%. That is the 3.2% floor plus a mandatory 150 basis points of pure risk premium. The harsh reality of the SGX is that the window of opportunity is already open and it closes incredibly fast. In this exact market environment, the critical difference between a safe sanctuary stock and a devastating yield trap is frequently decided in a single, volatile trading session. By the time this specific forensic analysis reaches you as a free public subscriber, the optimal entry window or exit point has often already opened and unfortunately frequently closed. Relying on delayed information when balance sheets are shifting this rapidly means you are stepping into the market blind to the underlying leverage risks. You simply cannot afford to be the last person reacting to a massive drop in distributable income. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. In this market, the difference between a sanctuary and a yield trap is decided in a single session, so do not wait for delayed data to do your thinking for you. Join Iggy's elite investors through the link in the description to secure your 0-day access before the 7-day embargo window closes. Let us establish the absolute bottom line for today's forensic audit. For Keppel, the glaring transparency gap regarding their first quarter profit is a massive concern. At 5.1 times leverage, it is a volatile hold and a strict watchlist trigger. For CapitaLand China Trust, it is a textbook yield trap with falling net property income, 40.7% gearing, and an interest coverage ratio of only 2.8 times. This distribution is being paid entirely on borrowed time. City Developments is a strategic neutral. The board consolidation is fine, but the real test remains hospitality recovery. And Oiltek is a watchlist trigger because a potential Bursa listing does not fix the fundamental requirement for higher margins. Think of the difference between a mature, stable flat in Tampines and a highly leveraged BTO in Punggol with constantly rising service and conservancy charges. The Tampines flat is your sanctuary with a clean balance sheet. The Punggol BTO is the exact kind of high-leverage growth bet that CapitaLand China Trust has unfortunately become. The day the concrete numbers disappear from a quarterly update is the day you must tighten your forensic grip. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.